Let's break down this chart step by step and understand what the market is really doing, not what we think it should do. Starting from the left side of the chart, the first thing we focus on is market structure. Price is clearly moving in a bearish structure, creating lower highs and lower lows. This tells us that sellers are in control and the overall flow of the market is bearish. When you understand structure, you stop guessing and start reacting to what price is actually showing you. As price continues, we eventually see a break of structure, BOS. This is a key moment. A BOS tells us that the previous structure has been violated, meaning liquidity has been taken and the market is preparing for a new phase. This is not an entry signal by itself, but it gives us context and direction. After the break of structure, the market doesn't continue impulsively. Instead, price pulls back into a very important zone, the area where the strongest move originally started. This zone is what we identify as our order block. An order block represents institutional activity where large orders were placed and left behind imbalance in the market. Not all order blocks are valid, but this one is special because it aligns perfectly with the structure and the BOS. Before price reaches the order block, something very important happens. The market creates inducement. This inducement is designed to trap traders into early entries or wrong positions. It looks like continuation, but in reality, it's the market collecting liquidity. This inducement acts as confirmation that the order block is still valid and that smart money is preparing to react from that zone. Now look at the lows. At the lowest point of the move, we can clearly see sell side liquidity resting below the equal lows. Liquidity is the fuel of the market. Price always moves from one liquidity pool to another. Since sell-side liquidity has already been collected, the probability increases that price will seek the next pool of liquidity on the opposite side. This is where our execution plan comes in. We wait patiently for price to return into the order block and show confirmation. We do not enter blindly. Once confirmation is present, we execute our trade from the order block. The stop loss is placed slightly below the order block. Not tight, not emotional, but logical. If price breaks and holds below the order block, our idea is invalid and we exit without hesitation. The target is set at the next logical liquidity level. In this case, liquidity resting ahead becomes our take profit zone. This gives us a clean, logical risk to reward setup based on structure and liquidity, not hope. Finally, remember this, without risk management, even the best strategy will fail. Risk only a small percentage per trade, stay consistent, and let probabilities work over time. This is how smart money trading works. Structure first, liquidity second, execution last. Follow Hazara Trader for more full market breakdowns and advanced trading concepts.